Let's talk now with Grant White. He's joining us from Winnipeg. He's portfolio manager and investment advisor at IA Private Wealth. Grant, thanks a lot for joining us. What kind of markets are you expecting in the second half of this year?
Yeah, I think more of the same, Paul. I think we're seeing choppy markets throughout the beginning part of the year, obviously, as we've seen, and some months choppier than others, obviously. But I think we're not out of that quite yet, and I think the remainder of 2025 is going to be quite choppy. But these are great markets actually for disciplined investors. I mean, this is actually opportunity time, and I think that for somebody who has a good strategy in place, who can stay disciplined to what they want to own, you're going to do very, very well in these markets. So just because it's choppy doesn't mean it's a bad thing at all. I just think that the undisciplined investor is going to get punished by this, but for the disciplined investor, you're in great shape, and I think this is opportunity time.
With indices at record highs, both here in Canada and in the United States, this sounds like a stock picker's market. You think there are stocks out there that are still trading at attractive multiples?
Yeah, I think that this market is dangerous for people who are going to chase returns. I mean, if you look at the United States, if you look at the Mag 7 in particular, I think anybody chasing the returns that we've seen in the Mag 7 have the potential to get hurt by that. I do think that there is some value in some of the companies there, like Alphabet, for example. But I think if you're actually focused in on the bottom part of the market, in the US would be the bottom 493 in the S&P 500. And you could say the same in the TSX. I think there is strong value in a lot of companies still. So, you just have to be willing to go outside of the main headlines to find them. But there's lots of value out there. I think the overall market, if you exclude like the top that's driving valuation, but if you exclude those top companies, it's more of a fairly priced market. And so there is opportunities in there. But you gotta look for them.
I see one big piece of advice you have to clients and investors at large is stay invested. Does that mean resist the temptation to take profits when markets are so high right now?
Yeah, I mean, I think that there's lots of good opportunities, and I think that resisting the temptation to take profits is part of that. I mean, I think you got to be careful with that a little bit, but I think what you want to do is ride some momentum in some of those trades for sure. But staying invested in general is a great idea throughout this, because I think there is going to be some shaky markets that are going to like push you to want to make a bad decision here. And again, we saw that earlier in the year, a few months ago, where a lot of people, and I think a lot of people have moved to cash and are still sitting on it. We're seeing money market funds with huge amounts of assets out there. And so I think a lot of money has been scared away from this, and they've missed out on this incredible run since then. And I think that that's also a very dangerous thing that could happen in the second half of this year. So resist the temptation to sell out of positions, especially good, solid positions that are capable of withstanding the volatility. Just ride it out and be ready to pick off good opportunities as they come up.
Okay, let's talk about some Canadian stocks that you like. One of them is one of the grocery giants in this country, Metro. Why do you like Metro? And its stock is the grocers have done well as consumer staples over the past year or so.
Yeah, I think Metro is still a really solid company. I think you can get it at a good price here. I've been looking at Metro for a long time as it compares to Couche Tard, actually. And I think that, when you look at the two side by side, both are good. I mean, we're still optimistic on Couche Tard as well, but I think that Metro is one that's somewhat being overlooked just because of all the headlines around Couche Tard these days. And so I think Metro is a good, solid pick. This is not one of your sexy, high-flying picks. This is one of those where this in perpetuity for the most part, as a core part of your holding. You've got a nice solid dividend, stable dividend, demonstrated growth. So the company is doing very, very well. They just spent a bunch of money on readjusting their logistics and building fulfillment centers, essentially. So I think that the short-term future for Metro is looking very strong. Again, it's going to chug along. This is a chug along company, and I think you're going to do well by owning it. But it's going to be that thing that drives the core part of your portfolio.
Why don't we talk a bit about Alimentation Couche Tard, which you mentioned in passing there. ATD is the ticker symbol. It's been a very disappointing year so far, and a very disappointing 52 weeks for shareholders of this company. We're looking at the 1 year graph right now. That's not the shape of graph that we've typically seen from Couche Tard over a 52 week period.
Yeah, I think Couche Tard is still, again, like nothing has changed from this company from a long-term perspective, in my opinion. Great management that has demonstrated that they can drive M&A, they can do great acquisitions and incorporate that into their business very well. Obviously, not the year that they wanted, not the year that shareholders wanted from this company. But in saying that, I don't think that this company is just become a bad company or a bad investment overnight. And so this is one where I think that if you're holding it today, I would definitely hang on to Couche Tard. And we're looking at clipping off positions as we go along. But the management's great, and if we're looking at holding this company for 5 or 10 years or longer, I'm not concerned about anything that we're seeing today. Would love to see some of the things work out for them that they've been working on, but we don't control that. But we do look at the management as very, very strong.
So, buying 7-Eleven, a good thing or a bad thing for Couche Tard?
I think it's a good thing, but the proof will be in the pudding. I mean, hey, again, they have a great track record of making good decisions on this, so I trust the management as it relates to this. Long story short is I do think it's a good thing if they can get the terms they want, and if this all goes through, then great.
Let's move on to another Canadian stock you like, Fairfax Financial, the insurance holding company, led, of course, by Prem Watsa.
Yeah, I love this company. I mean, I think this is just a solid, stalwart Canadian company. And especially, when we're talking about volatility, I love a company like Fairfax who, frankly, is going to ride the rapids through this quite easily. I think you're getting them at a really good price right now. What I think is overlooked in this, I mean, a lot of people are looking at dividend yields all the time, but I think you're going to be looking at the buyback yields as well on a company like Fairfax, which has consistent buybacks. And when you look at that combined with the dividend yield, you're getting into a 3 to 4% total yield type of range. And so I think that's a great yield on a great company like this. You're buying them at pretty low PEs right now. They've got diversified free cash flow. So very strong from that front. And overall, just a solid company that's demonstrated the ability to perform well over long-term periods of time. So I think you're getting a great company at a great price right now. And frankly, they're giving you the vote of confidence when they're buying back their shares. They obviously feel it's cheap as well. And that probably correlates to a better share price in the near-term future as well. So overall, a great company, especially if you're a little bit concerned about what the markets are going to do in the short term. I think Fairfax is going to ride it out pretty well.
Okay, and the third stock that we want to talk about is perhaps less well-known, Exchange Income Corporation, a diversified operator in regional aviation, among other activities.
Yeah, so again, coming from Winnipeg, I try to plug a Winnipeg company when I can. But obviously, this company has done very, very well. I mean, this is another kind of chug-along company. And over the years, as I've thought maybe they might run into some trouble or get tripped up on stuff, they continue to perform well. Their management has done a great job of navigating through various different tough situations, frankly, whether it's pandemics or you name it. So the management's done a great job. They continue to be a great M&A company, and again, have demonstrated that they can do that quite successfully. One of the things I want to mention about this company is I also love the culture. In chatting with some of the CEOs of the companies that they have acquired over the years, the CEOs tout great culture within the organization. Bringing idea sharing together. This huge, basically think tank of CEOs, and that's one of the things that really I think is really special about Exchange Income. Again, solid dividend around 4% right now, and it looks like a stable dividend from what I can see. And so I think that there's it's a great company. It's been managed very well, but there's also great opportunities. Right now they've got a deal on the table with Australian Security to watch the coastlines for Australia, for example. And as they continue to do deals like that, I think they're going to do very, very well. So not overly a cheap price today. I think it's more fairly priced, but I think you're getting a solid company at a fair price today with Exchange Income.